Good evening, everyone. My name is Cesar Mondragon. We're presenting Chapter 8 closing case, particularly the East Coast Yachts case. So background, initial analysis, and projections. So a little background, Larissa has decided to have Dan examine the feasibility of a new manufacturing plant. Larissa would like Dan to analyze the financial viability of the new plant and calculate the profitability index, net present value, and the internal rate of return. This expansion will represent a major capital outlay for the company. A preliminary analysis of the project has been conducted at a cost of $1.2 million. The new plant will require an initial immediate investment of $55 million and an additional outlay of $30 million the following year. The company has received a special dispensation that will allow the building and equipment to be depreciated on a 20-year MAC-RS schedule. No sales will be possible for the initial year, so year 0. 2 years from now, the company will have a partial year sales of 18 million. Sales in the following 4 years will be 27 million, 35 million, 39 million, and 43 million respectively. Because the new plant will be more efficient, viable costs are expected to be 6% of sales and a fixed cost of 3.5 million per year. Required net working capital amounted to 8% of the sales for the next year. Cash flows after year 5 will continue to grow at 3% indefinitely, and a tax rate of 21% and the acquired return rate of 11% is projected. Larissa has instructed Dan to disregard the value of the land the plant will be required. East Coast Yachts already owns it, and as a practical matter, it will go unused indefinitely. She has asked Dan to discuss this issue in the report. So going into a little background of the current yacht industry market. So just consider an outlook. The market is fragmented. This means that there are multiple manufacturers. However, it has experienced overall high growth rates. All right. North America accounts for 21% of the growth in the market, with Europe 36% and an overall 11.32% between 2021 and 2025. Of note, there is incremental growth at through 321 units projected between 2020 and 2025. This tells us that there is a potential to capture substantial market share. This because the industry is very competitive due to its niche market, being a niche market, a high production and operating cost. This again gives us room to develop innovative cost and cost-cutting processes, and production, which this project Larissa is hoping will bring. All right, so getting into the calculations. First, we have to account for year 0 and year 1 investments, depreciation schedules. And then that gives us a total depreciation schedule, so between year 0 to year 5. As you can see, total depreciation was positive. Again, these calculations allows us to calculate the operating cash flows. Between year 1, year 2, we did see some negative net income because of those initial investments or outlays, but year 3 to year 5 we saw positive growth in our operating cash flows. Once we calculated the operating cash flows, we were able to calculate the net working capital. So the net working cash flows amounted between 1 million in the initial year to just over 320,000 year 5. As we mentioned before, we are looking to at a terminal growth rate at 3% and a required return at the year 5 year mark of 11%. Knowing this, our total cash flows for year 5 or operating cash flows were at $10,608,002. Year 5 cash flows, again, were at a positive number. So then this allows us to actually calculate the PI. PI, looking at is the PI is calculated by dividing the present value of future expected cash flows by the initial investment amount of the project. A PI greater than 1 is deemed as a good investment with higher values corresponding to more attractive projects. Our PI was at 0.21%, so it's not that 1 that we were looking for. However, it is not a negative PI. This is important because we have to consider that the size of the project. So again, this is a substantial project dealing with really high amounts of cash. The profitability index, or PI, does not take into account the size of the project. So a large project with lower profit margins may have a lower profitability index than a smaller project with higher profit margins. So again, this tells us we need to look at the NPV and the net present value, the IRR. So going into our net present value, or NPVs, net present value is used to calculate the current value of a future stream of payments from a company, project or investment. Our NPV was at $17,528,892. If the NPV of a project or investment is positive, it generally means that a rate of return will be above the discount rate. So a positive NPV indicates that the projected earnings generated by the project exceed the anticipated cost, also in today's dollars. Therefore, we can assume that this project will be profitable. Finally, looking at our internal rate of return, our internal rate of return is our example exceeds the required rate of return of 11%. This would be a safe investment for the company. Just looking at that, our internal rate of return was at 15.91%. However, before deciding to invest in the project, management must weigh the accuracy of their assumptions. This is because certain assumptions can cause the ARR to become overstated. That being said, I would recommend that this project, we would invest in this project, simply because although the profitability index for this project is not a 1, it is not a negative number. We must consider the profitability index does not take into account the size of the project. So a large project with lower profit margins may have a lower profitability index than a smaller project higher than higher profit margins. So I think we need to look at the additional indicators which the NPV and IRR will give us for this particular project. Our NPV was a positive NPV at $17,528,192. This project essentially shows that the present value of cash flows generated from this project exceed the cost required for the project. Therefore, we can assume that this project and investment will create value for the shareholders by generating profitable results. Then finally, the IRR, which we came up with 15.91%, exceeds the discount rate or required rate of return of 11% that was required by Larissa. This being a positive and above the required return gives us that buffer that we need to be able to have confidence in our recommendation to invest in this company. Other than that, that is all I've got for tonight. Thank you and have a great day.